Hey everybody, it's the 40 Finance channel. My name's Jeff Beers, and today we're going to go through each of the FAANG stocks and ask the question, is this stock overvalued or undervalued or just right? If you like stock market analysis and personal finance content, then be sure to subscribe to the channel. I appreciate all the support you give. Let's jump in. Okay, starting with the F in FAANG is of course Facebook. Now, I used a site here called Macro Trends that has these really handy charts to compare the stock price, the net earnings per share, and the PE ratio. It gives you a really nice high-level view of how the valuation of Facebook and other stocks have been trending over the past few months. You can change the date on these graphs to go 1 year, 2 year, 3 year, 5 years, and even further. So definitely check out Macro Trends if you have time. So we see here with Facebook, in the top is the stock price, and this is a 2-year chart for all three of these. And the stock price has not quite back to its peak high, which occurred last year around August, right before the crash of the stock market heading into December of last year. So it's made it back up to about the $180 level. The high for Facebook encroached on $200 late last summer. So we know that the price is down a little bit from last year, but here we see that the earnings per share are actually up significantly to over $7 a share. And when we look at the PE ratio for Facebook over the past 2 years, the PE ratio is actually near the low we saw in December, where everything had a low PE. So when you take all this into account, you think that the stock price is really at about its average of last year throughout the year. The EPS is up significantly over the past couple months, and the price per share, the PE ratio is down near the December lows. I look at Facebook and I say, this is probably a stock that is undervalued compared to the performance that it's had in recent years. You can let me know what you think in the comments below. Moving along to an A in FAANG, and I chose Amazon for the first A. Same thing here, 2-year time stretch. The stock price has obviously rocketed up, but it's still not at its high of $2,000, which, just like Facebook, was late last summer. The earnings per share however, have grown relatively well since then. We're up to $20 earnings per share. And the PE ratio is really low compared historically to where it's been from an Amazon perspective. You're looking at a PE ratio of about 100, which sounds extremely high, and it is compared to other stocks out there. However, if you would have said, I would have, for example, bought Amazon 2 years ago, you could make the argument that the signals today are stronger to buy than they were 2 years ago. So it just depends on what you see for Amazon's future. Obviously, with Amazon, you have a company whose profits are increasing rapidly, and they're coming off of a time not too long ago where they were not even profitable, and people wondered, is their growth story really sustainable over time? So there's a lot of things to think about with Amazon, but to make a statement on this stock, I would say once again, it is probably slightly undervalued compared to where it ran last year. Let me know what you think. Next up is another A in FAANG, and that is of course Apple. And we know that Apple took a hit last year when there was concerns about the iPhones not selling. You see that over the past 2 years, it's had a general upward trajectory. And then once we reached into Q4 of last year, I think the statements came out that sales of iPhones were slowing. And that combined with the Chinese trade concerns had the stock drop dramatically. Since then, the stock has bounced back up. It is trading a little bit higher than it was throughout the average of 2018, but we see here to coincide with that price increase has been a relatively substantial earnings per share increase. In fact, now we're over $12 per share, whereas last year around this time, you were looking at just over $10. So a nice growth in earnings per share. The PE ratio, which peaked back again right around September, all the way up to almost $20. The P ratio has dropped dramatically, and it is now down to $16, which is about on par with what it was doing back in 2017. So is Apple a good value or a bad value based on these metrics alone? I would say from my perspective, Apple is priced correctly right now. However, I would have no qualms about buying it at the $200 share price because I see that the earnings per share are going up substantially and the PE ratio is just right at the tip of its average. You can definitely get Apple today for a much better deal from a value perspective than if you bought it, say, 12 months ago. So for that reason, I would say I'm bullish on Apple, but the current price from today's perspective is just about right. Let me know what you think. Next up, we're into the ends for Netflix, and Netflix has historically had a lot of commentary around its PE ratio and stock price. And you see here that 2 years ago, you could have got Netflix for about $150. It has skyrocketed all the way into last summer where it reached its peak around $400. The stock came down like everything else in December. And now we're up into the 370s, 380s, depending on which day you look at. Now, if we look ahead to earnings per share, we see something a little different where the earnings per share grew well with the stock price, except for this last little bit heading into 2019 where it dropped ever so slightly. So you see an earnings per share drop, then you go to PE ratio, and there hasn't been a lot of movement here. You're still running really close to the 200 mark. However, now Netflix is available closer to its December lows at just over 100 in the PE ratio. My take on Netflix when I look at this is I really do have concerns of how much longer they can continue to grow. And I know while not represented on this chart, the cost of content is absolutely unbelievable, the money that they're spending. However, everybody's spending on content these days, so some of that is negligible. I just worry how many people are left in America and what is left on Netflix plate for international. They obviously want to try to get into India, China, all those things. And if that works, great. This can continue to go up. However, right now, knowing what we know, I would say that Netflix is slightly overpriced. If I was going to buy it as an individual stock, I would probably wait for it to reach very similar to the December lows that came out of trade fears. So in the neighborhood of $300, $320, that would bring your PE ratio down a little bit, and it would make up for this minor blip in EPS that has went down. So if I was an investor, I would wait on Netflix for the price to come down a little bit, and I would be paying a lot of attention to their quarterly reports. Next up at G is Google, although Google is technically Alphabet, so that's kind of an A, but you know, we'll flow with it here. Stock price for Google has recovered very well from the same December lows that everyone else has seen. We're right back at $1,200. But meanwhile, behind the scenes at Google, earnings per share took a significant jump. And there's really no indication that the earnings per share will stop growing at this level right now. The only knock on Google right now is they're making 2019 and 2020 a capital expenditure period where they're reinvesting into a lot of their core businesses, which of course means cost, and that typically scares shareholders. So earnings per share way up. The PE ratio for Google has come down dramatically over the past 12 to 14 months. So what you see here at a level right under 30 in the 27s or so, you're back at the PE ratio for 2017, where earnings per share were only $30 per share. Now you have earnings per share over $42. The prices went up substantially. However, with stock buybacks and other things that they're doing, the PE ratio has dropped considerably. So when I think about Google as a stock, whether or not I would invest in them, I would say right now at this level, the price feels really good. I would personally probably wait for the next quick downturn in stock, see if I could get it at 1150 or so. If you watch Google on a daily basis, it has some ebbs and flows. It never goes wildly one way or the other, but you can usually knock $50, $60, $70 off the price just on a given day when there's sour news out in the financial markets. So I feel bullish about Google in the long term. Price today isn't bad, but I'd try to find a 10% discount maybe when the markets are on a downturn, and then of course invest for the long term from there. All right, guys, so that's our look at FAANG PEs, earnings per share, and stock prices, trying to figure out which ones are still a good value. I think, in my opinion, I don't like hearing on the news every day that FAANG's overpriced, FAANG is this and that. Sometimes you got to look at the numbers and create your own opinion, which is what I did here. And I would say, generally speaking, FAANG isn't the best value in the stock market right now. However, the fears of it being wildly overpriced when you start digging into each individual stock, I think that story's been sold a little harder than the truth is. But of course, make your own decisions and do your own research. Hope you enjoyed this video. We'll see you on the next one.